Welcome everyone to Spread the Love, State Compliance Considerations. Thank you all so much for joining us. Our moderator for today's call is Beth Allen. She'll be answering the questions you sent through the Q&A today. We will try our best to answer all of your questions, but if for whatever reason we are unable to get to your question today, please follow up with your advisor for further assistance. Today's presentation is being recorded. We will be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday, you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At this time, I'd like to hand over the call to Beth Allen, Vice President of Benefits Compliance and Plan Document Operations at NFP. Beth, the floor is yours.
Thank you so much, Amber, and welcome everyone to Spread the Love, State Compliance Considerations. Yesterday was Valentine's Day. I'm sure we're all on the phone with some kind of sugar high, hopefully. In my house, we love the little Reese's, and so everybody got that from each other. But today we're talking about state compliance considerations. Next slide. You're going to be hearing from Kelly Ekman and Yoko Yoon, some of the newest members to our national team, and they're going to go through all the state things that you got to consider. And obviously, although we often provide you all guidance informationally, we're not providing legal or tax advice, so that has never changed, and that's still kind of what we got going on today. And so we wanted to kick off today's call with actually a poll, because those of you who are employers on the call, we kind of want to get an idea of how many employees you might have in different states. And so the question is, do you employ employees in A, 1 state only, B, 2 to 10 states, C, 11 plus states, or D, I have no idea? That last option might seem a little bit unreasonable, but I think that we all can appreciate the fact that with COVID, people started to just move around, and sometimes their employers didn't know. And so that's kind of where that sentiment came from. So we'll give about 5 more seconds for everyone to fill out the poll. Ooh, big numbers there for employers with 11 plus states. I guess that makes sense because you wanted to be on today's call. And so, yeah, but that's really interesting information. And with that, I'm going to kick it over to Kelly to start off with the agenda for today's call.
All right, thank you, Beth. And yeah, that poll is really helpful just to kind of get an idea of who we have on the call and kind of what you guys are looking for. So today we've got a lot of topics to cover. We're really just going to hit these kind of at a high level because we really could spend an entire hour on each of these topics on their own. So we're going to look at state individual mandate reporting requirements, other state reporting and disclosure requirements, Mini-COBRA, paid family medical leave, a hot topic, commuter benefits, and then we will quickly touch on takeaways and resources and potentially Q&A if we have time. Now, what we won't be talking about today are federal and state tax implications. We're not going to be talking about, payroll or wage withholding requirements, HR policies beyond kind of those things that may touch on benefits compliance. Some states do have developing long-term care mandates. Again, not covering that today, nor are we looking at retirement or worker safety protocols. Now, have no fear, we do have some resources available for you in case those were topics you were hoping to see today. So NFP does have an HR solutions group, and then we have a lot of really good website resources here for various state tax departments. DOL has their wage and hour and OSHA rules, various state labor offices, and some HIPAA links. So definitely check these out if these were some topics you were hoping that we were hitting on today. Okay, so we're quickly going to start just with a really quick overview of state insurance law. Okay, and so it's important to remember today that, each state has health mandates that generally apply to insurance policies issued, or sometimes you'll hear it called written, in that state. So self-insured plans generally do not have to comply, emphasis on generally. Likewise, policies that are issued in other states generally do not have to comply with these health mandates. Employers that have employees in various states, or you have offices really in various states, you may have flexibility to choose the state in which your policy is issued. Now, each state is going to have its own requirements for what will allow a an employer to have a plan written in that state, but definitely may be something you want to look into if you do have offices in multiple states. Now, here's where it gets a little more dicey. So some states have what we call extraterritorial health mandates. Okay, so these are additional requirements on plans that are, outside of where that plan is written. So these mandates are going to apply to coverage delivered to residents of that state. So we think about it as the mandate being applied on the employer as opposed to on the insurance policy itself. So that comes into play when maybe the policy is written in one state, but this law is going to apply if you have residents in that state. So an example, one of everybody's favorite, California. So California requires that fully insured plans cover domestic partners. So even if your fully insured plan is written, let's say here in Indiana, where I am, if I have employers in California, my fully insured plan would still need to cover domestic partners. Similarly, Texas is another state that likes extraterritorial mandates. So they require fully insured plans to cover unmarried grandchildren. So just some examples that just because you have a fully insured plan written in a state that maybe doesn't have a lot of mandates, it doesn't mean you're going to be off the hook. So our first topic we're going to dive in today are state individual mandate reporting requirements. Okay, and so I think, a lot of people are familiar with the employer mandate under what we think of with the ACA. And so that generally applies to employers with 50 or more full-time equivalent employees in the prior calendar year. Now, some states also have their own individual mandate reporting requirements, and those requirements can apply to employers of all sizes. Now, we really saw this come about once the federal individual mandate penalty was reduced to 0 back in 2019. So we saw some states add their own mandates kind of to counteract that change. The big thing to note here is that these reporting requirements are based on an employee's home address and not the employer's address or not the employer, the work site in which the employee reports. So their home address. Currently, we have 6 states that have individual mandate reporting requirements. And again, you can see a lot of these came about in 2019 and 2020 after that federal penalty was reduced to 0. So we're really just going to do kind of a brief overview of those 6 states and their requirements. Again, we're not doing a deep dive into every nuance of the law, but really just want to give you an idea if you do have employees who are living in one of these states. So our first one up today is California. So California says that employers with at least one employee, spouse, or dependent that is enrolled in your medical plan and resides in California is subject to this mandate. So to comply, forms need to be distributed to employees, and then you must report minimum essential coverage to the state. So for self-insured plans, pretty easy. They can use the federal form 1095B or 1095C that they've already been using to report. Fully insured plans, the carriers typically handle this reporting, but we always say you want to confirm with your carrier to make sure that they are handling that on your behalf. You don't want to assume. So when is it due? So the forms are to be distributed to employees by January 31st. And then the filing is due to the state by March 31st, although they do provide a grace period of May 31st. If the filings have not been made after May 31st, or they're not done at all, California can impose a penalty of $50 per person for failure to report. California does say that electronic filings are required if you are filing 250 or more forms, which really tracks along with the federal rules as well. District of Columbia, so DC is slightly different. So for their individual reporting requirement, it really tracks along with federal rules. So it's saying if you are a self-insured plan and you have at least one employee who is enrolled in your medical plan that resides in DC, then you have a reporting obligation. If you are a fully insured plan, then if you have 50 or more full-time equivalent employees, and at least one of those employees is enrolled in your plan who resides in DC, then you also have a reporting requirement. Again, tracks with those 6056 reporting requirements. Now, what's nice with form distribution is that, if an employer is complying with the federal rules for distributing 1095B and C, they will satisfy DC's requirements. And then the second step is filing those same forms with the state. And there's the DC website, mytax.dc.gov, where those forms get filed. The forms should be distributed to employees by March 2nd, again, same as the federal deadline. And then those filings are due to the state by April 30th of each year. Currently, DC does not impose a penalty, but obviously we're going to say employers need to make sure you are complying if you do have those DC residents covered under your plan. The final note here, DC does require electronic filing only. There are no paper filing options for DC. All right, Massachusetts. So Massachusetts, the requirement is that if employers have at least one employee, spouse, or dependent enrolled in the medical plan who resides in Massachusetts, they have a filing obligation. So Massachusetts, again, we kind of think of them as like the OG. Their requirement's been around since 2006, so they do it a little differently. So they have their own form called MA 1099-HC, and that's the form that gets distributed to employees. And then they have what they call minimum creditable coverage, or MCC reporting, that is due to the Massachusetts Department of Revenue. So for self-insured plans, the employer must distribute the forms and then also do the reporting to the Department of Revenue. And then for fully insured plans, again, we normally say carriers typically handle it, but you always want to confirm. This is especially true for plans that are written outside of Massachusetts, because their reporting can be a little more tricky than what we see with other states. And Yoko, did you want to add anything on this one?
Yeah, thank you, Kelly. So just to chime in, like from the field side, practically speaking, what we have seen is that employers are mostly employees out of Massachusetts, but may have some one or two employees in Massachusetts. And so the carrier is out of state, or could be a self-insured. In that case, generally what we have seen is the carriers are not doing the MA 1099. So that means full onto the employer. So the important tip is to check with the carrier. If they're not doing it, then employers need to have that full responsibility. There are some vendors that would do on behalf. So I just want to give you a heads up that it's important to check with the carrier. And the next step is to check with our consultants and then see how we can assist you in the compliance with this. Thanks, Kelly.
Awesome. Thanks, Yoga. Yeah, always good to get a little more practical advice and insight on some of these reporting requirements. For Massachusetts, the reporting requirements are, we're both due on January 31st. So if you did have Massachusetts employees, hopefully this was taken care of. If not, we highly recommend working with outside counsel as soon as possible. There is a penalty in Massachusetts. It can be a penalty of $50 per person up to $50,000 for the year. And then just an additional note that the 1099-HC is sent to the enrolled employee. It doesn't have to go specifically to covered dependents as well. Okay, New Jersey. So New Jersey's mandate, again, it applies to employers with at least one employee who's enrolled in a medical plan and also resides in New Jersey. Like some of the others we've mentioned, their mandate requirement really tracks to the federal mandate as well. So if you're a small, so again, under 50 employee self-insured plan, they're going to use Form 1095B. If you're a large self-insured plan, you're going to use Form 1095C. And again, that's just the same as what is required under the ACA. And then for those fully insured plans, again, carriers should be handling it, but you always want to confirm. If for some reason the carrier is not filing, then the employer must file either with 1095B, or New Jersey actually has its own form, NJ 1095, which is also a way that employers can report that information. So those forms get distributed to employees, and then those forms get filed with the New Jersey Division of Revenue as well. They are due by March 2nd to employees, and then they are due to the state by March 31st of each year. Currently, New Jersey does not have a penalty for failure to file, but again, we want to make sure that we are you're staying on top of those requirements. New Jersey is another state that has an electronic filing option only, so there's no paper filing available. And then employees, again, they can only use 1095C in those situations that we mentioned above if parts 1 and 3 are complete. So basically it's meaning that it's giving that identifying information, and then it's showing the months in which someone is enrolled in that plan. Okay, Rhode Island. So again, employers must have at least one employee in the plan who also resides in Rhode Island. This is another one that's really going to track with the federal mandate requirements. So you're going to use either 1095B or C to satisfy those distribution requirements to employees. And then if you are a self-insured plan, you are responsible for distributing those forms and reporting it to the Division of Taxation. And then for fully insured plans, once again, carriers should be handling it, but you always want to confirm. These deadlines track the same as the federal deadlines. So distribution to employees by March 2nd, and then filing with the state by March 31st. This is another state that currently has no penalty for failure to file. Rhode Island's kind of interesting. They've made a note saying that if for some reason the federal reporting requirements change, they still will impose an individual mandate reporting requirement on employers. So even if the Fed rule goes away, employers won't be off the hook quite yet. And then finally here we have Vermont. So Vermont's a little bit different. So Vermont has an individual mandate that requires residents to have minimum essential coverage. Currently, there's no penalty and no enforcement of the mandate, so there's actually no employer reporting requirement at this time. Basically, residents just have to indicate whether or not they had minimum essential coverage when they're filing their taxes. Obviously, if this changes, we'll let everybody know, so stay tuned for additional updates as they may arise. Now, have no fear. I know we went through a very quick overview there. We do have a wonderful publication available called State Individual Mandate Reporting Requirements. It's really going to go into more of those details that I didn't touch on just now, but for those 6 states that do have reporting requirements. So if this is something you're interested in, you can request a copy of this publication from your consultant. And with that, I'm going to hand it over to Yoko to cover other state reporting and disclosure requirements.
Thank you, Kelly. So today, in addition to the state's individual mandate reporting that Kelly just went over, there are 3 additional states with city reporting requirements that we would like to bring to your attention. The first one is the San Francisco Healthcare Security Ordinance. It's been around for several years, and thankfully during the COVID time, the reporting requirement was on break for 2 years, but now back on compliance now. So employers need to do it from last year and this year as well. And yeah, so I just, since the deadline is like closest, so I'm gonna go hit from the San Francisco one. So this applies to both fully insured and self-insured, and an employer with at least one covered employee, we're gonna talk about it, and an employee 20 plus employee worldwide, or 50 employee plus worldwide for nonprofit clients. So covers a lot of clients, but if your office or employee, so this applies to employee who work in the city or geographic boundary of city and county of San Francisco. It could be working from home as well. Even if you don't have physical office there, if you have one employee working from home in San Francisco, this applies to you. And the covered employee is work there and then work employee for more than 90 days for the employer and work at least 8 hours per week. So this requirement is basically stating that they set the threshold of how much the employer contribution needs to be made for those covered employees. And fully insured is more straightforward. If you don't meet that, then there are other options to supplement. And then tricky part as a tip is that if any of your San Francisco employee waive the coverage, and that's additional thing that you need to consider. And we have the resource to talk about, but for the interest of time, for the self-insured, it's a little bit more work because you have to calculate the claim paid within 2022. And if you don't meet that threshold, then you have to make the top-off payment, they call. So the difference of how much that you did not pay because of the claim paid within 2022, and that payment is due by February 28th this month. And another requirement that you have to do is display the poster. So you have to post the new poster every year by January 1st and submit the reporting. This is the emphasis of this slide. So April 30th being Sunday, so the deadline is May 1st this year, and submission is site will be open on April 1st, and this is done online. So this needs to be done every year, and the reporting is based on the 2022 information. Next slide, please. So moving on to the Midwest, Illinois, this kicked in last year, and this applies also to fully insured and self-insured. It's called consumer coverage disclosure. Some people call it EHB disclosure. So basically what this state is intent is requires employers with Illinois employees. It could be out of state employers, and as long as you have employees in Illinois, I know it's a little bit tiny on the right side. It's a screenshot, as you can see how detailed it is, to compare that essential health benefits that these marketplace sell in the individual place, compare that with your plan, whether if you cover certain benefit or not. You just say partially or yes, you do cover, and you complete that form, and you do not submit this with the state. Your requirement is to complete this every year and then distribute it annually and upon hire and upon request. And the disclosure template is like kind of Excel form that you can take a look in the link when you receive the copy. Okay, next slide, please. So the next one, so Kelly talked about the Massachusetts individual mandate reporting, which is they call MA 1099. And in addition to that, if you have employees in Massachusetts, 6 or more employees in Massachusetts, and in addition that you have to comply with this HIRD reporting requirement. Thankfully, it's not due till later this year. This is an annual requirement, and then the site is open usually around November 15th, and the deadline is December 15th to just explain about the plan and coverage. And the objective is for the state to know whether those individuals who are receiving premium tax credit are matched with your information. They're not qualified for your plan or certain level plan. And as you can see, the screenshot on the bottom right, that's the online. So thankfully, this is like pretty not that complicated if you kind of get used to that process. Thank you. And I hand it back to Kelly to talk about the Mini-COBRA.
All right, thanks, Yoko. So yeah, now we're going to talk about Mini-COBRA laws. Sometimes you also see this called state continuation. So here's a quick map from the Kaiser Family Foundation. So there are actually 40 states that have some type of COBRA continuation or Mini-COBRA coverage available. So again, we could spend this entire hour, or honestly, probably 2 hours going over all this. So really, we're just going to talk through just some high-level basics and just kind of, again, we want this to be on your radar so that if you do have employees in some of these states, you make sure that you're talking with your carriers or working with your employment counsel to make sure that these are being covered. So what is Mini-COBRA? First and foremost, like I said, COBRA laws are complex, whether we're talking about this from the federal or state level. So obviously work with outside counsel. We can't stress this enough today. Mini-COBRA laws are typically found in state insurance law, kind of what we talked about at the beginning with, our state insurance law basics. So usually it's going to apply directly to the carrier instead of applying to the employer. But like I said before, there are exceptions. So state Mini-COBRA laws really fall into two buckets. So the first bucket being Mini-COBRA laws that apply to employers that are not subject to federal COBRA laws. So think of those as the employers with fewer than 20. And then the second bucket are Mini-COBRA laws that may apply to employers of all sizes, and they're really going to extend continuation options longer than what federal COBRA requires. Okay, so first we're going to look at that first bucket for those small employers. So again, even though an employer is not subject to federal COBRA, they may still have to comply with state Mini-COBRA laws. Now, they can't make it easy. So each state is going to define it differently. Some states are pretty simple and just say fewer than 20 employees. Others may specify 1 to 19 or even 2 to 19. Each state may have their own counting methods to determine headcount. So that's why it's very important to work with your carrier to determine what applies in your state. Like we said before, typically these small employer Mini-COBRA laws are only going to apply to fully insured plans written in the state with that requirement. But again, always confirm with the carriers. Typically, the continuation is going to range anywhere from 3 to 36 months, just depending on the state. And then sometimes states will have additional restrictions. So they might say that you had to have been covered under the plan for 3 months prior to termination, or it's only available if you are ineligible for other group coverage or Medicare. And then the qualifying events that trigger continuation can vary quite a bit depending on the state. So we're really just going to look at 2 examples here of states that have small employer Mini-COBRA laws. Again, there are many more than 2, but just kind of want to talk through what it looks like. And then again, you can easily see some differences between what the states offer. So for California, I think a lot of people are familiar with CalCOBRA. So California does have a Mini-COBRA law for employers with 2 to 19 employees on at least 50% of its working days in the preceding calendar year. So individuals who may be eligible, so they were covered under the plan the day before the qualifying event, and they're ineligible for other group coverage or Medicare. This Mini-COBRA can last up to 36 months. That may trigger. So kind of some standard events we think of. So termination or reduction in hours, death of the covered employee, divorce or legal separation, the employee enrolling in Medicare, or someone losing dependent status under the plan. So just one example. Now a second one is Maine. So Maine is a little bit different. So Maine defines their employer eligibility as employers with fewer than 20 employees offering a fully insured plan. Now here's where it gets a little interesting. So Maine says that their Mini-COBRA law applies to policies issued in other states if they cover employees with a primary workplace in Maine. So again, it's not just applying to a fully insured plan written in the state of Maine, but it may also apply to a policy written elsewhere if that policy covers Maine residents. Their eligibility is a little different too. So the state of Maine says the covered individual must have been employed for at least 6 months prior to the event, and they must be ineligible for other group coverage. And then interestingly, dependents may also be eligible if they were covered under the plan for at least the 3 months prior. Now, unlike California that lasts for 36 months, Maine Mini-COBRA only lasts for up to 12 months. And they have a much more limited qualifying event list. So For the state of Maine, you're only going to be eligible if your event was due to a layoff or a loss of employment due to the covered employee's work-related injury or disease. So a much smaller kind of pool of events to qualify for Mini-COBRA in the state of Maine. Again, just giving a kind of an example of two states and the way their Mini-COBRA laws differ for small employers. Now, that second bucket of Mini-COBRA coverage we talked about are those laws that provide for extended coverage. So just because an employer is subject to federal COBRA, it doesn't mean they're off the hook with some of these state Mini-COBRA laws too. Like we said before, each state's going to define it differently. So some states will apply the extension to employers of any size, whereas others may segment it. So they may say only employers with 2 to 50 employees may be eligible for this extension of coverage. Again, like we said, typically it's going to apply to fully insured plans written in that state, but you always want to confirm because there are exceptions. So an exception on this extension of coverage is Wisconsin. Continuation duration. So typically what happens here is it gives an additional 12 to 18 months of COBRA on top of what someone may have received under federal COBRA. Generally, what's going to happen is the total between what someone is eligible for under federal plus state extension is not going to exceed 36 months. Some states are kind of interesting too. Some provide it again as an extension on top of federal COBRA, but others actually require individuals to choose between the two. So someone actually has to choose whether they're going to take that continuation under federal or state COBRA allowances. And then like what we saw with our small employer, the qualifying events that allow for that continuation can differ by state. So we'll look at two examples here again, just to get an idea of how some of these extension of coverage rules under Mini-COBRA may differ as well. So for this one, again, we're sticking with California, because not only do they have Mini-COBRA for small employers, they also have Mini-COBRA. This part applies to employers with 20 or more employees. It's going to apply to an individual who is covered under the plan the day before the qualifying event. They are ineligible for other group coverage or Medicare, and they have exhausted 18 months of federal COBRA coverage. So again, it's stacking on top of what someone was already allowed under federal rules. So really, they say the duration is the balance of 36 months minus the number of months they had on federal COBRA. Qualifying events, again, they're really the same as what they allow under the small employer Mini-COBRA law as well. Now shifting to the other coast, we have Connecticut. So Connecticut's extension of coverage under its Mini-COBRA law actually applies to all fully insured group plans regardless of size. So it's not like California where it's saying only those 20 or more. It's going to say any of our fully insured plans can have this extension of coverage. The individual must have been covered under the plan the day before the qualifying event, and they're ineligible for other group coverage or Medicare. Unlike California with 36 months, Connecticut sets its limit at 30 months. So 30 months minus the number of months that someone had under federal COBRA. So that's the duration they can get between the two. And then for Connecticut, their qualifying events are really pretty much the same as what California had. Your basics of termination or reduction in hours, layoff, death of employee, divorce, separation, Medicare, loss of dependent status, and then they also include a leave of absence for a covered employee. So basically something that otherwise would have led to a loss of coverage for that individual. Okay, and like I said, these are really just an overview. Obviously, you want to work with your insurance carrier and your employment law counsel if you do have employees in these states, because it can get quite complex when we think about the fact that some of these laws apply to plans that are written in other states. Okay, and now Yoko is going to lead us through a really hot topic these days with paid family and medical leave in the various states.
Great, thank you, Kelly. So this slide shows the latest of which states have that paid family and medical leave enacted. Some of them are already enforced and some of them are up and coming. And some things to highlight is Oregon and Colorado. Their employee contribution payroll deduction started from 1/1/2023. So double check that if you have any employees who work in those states and make sure that their employee contribution is set up with the payroll vendor to withhold their contribution amount from 1/1/2023. And one thing to note about Colorado is even if you're thinking about choosing the private plan route, for Colorado case, you have to still start withholding the employee contribution amount. And once the October of this year hit, if your private plan gets approved, then you get the refund for the amount that you contributed to the state. So I know it's a bit like a complicated scenario, but either way, you have to start withholding for Colorado for the private plan option as well. And as you can see, like we did not include a lot of additional states that are actually moving along the proposed rule and passing the Senate and just moving along to be finalized legislation. But some of them are Minnesota, Michigan, Virginia. So there are additional states PFML that we may see this year too. And the right side of the green grid list might be a good list to check to see which states that you have employees working in those states. So except for Delaware, states PFML, also called PFL with disability insurance, applies for if you have at least one employee working that state. Could be working from home as well. And the good tip is like if you're paying for the unemployment insurance for that employee, then usually automatically applies for the subject to the PFML for that employee as well. Next slide, please. Great. So some highlights that we've been getting confusion from the employers, understandably, that we want to untangle some confusion here is, so first step, I know it is overwhelming, and unfortunately, each PFML program is very unique and different. So it's important to understand that each where your employees are located, so you know which states PFML that apply to you. And as mentioned, even if like you are self-insured, or even if you have only one employee in New York, you are still subject to that PFL or PFML. And another confusion that I've seen is that a lot of employers sponsor STD, short-term disability or long-term disability. And some employers, understandably, but they think that having the STD will automatically kind of extend themselves from complying with the state's PFML. But unfortunately, that is not the case. We're going to look at the example how that STD and PFML run coordinating, but I just want to highlight that having STD is employer's choice, is not required, but it's a good thing, but it does not mean that you're in compliance with the state's PFML. And another, because the short-term disability usually means that you cover for the employee's own serious health condition, but it does not cover it for employee to take time off to care for family member or other reason like safe leave, for example. And also likely the STD benefits will not be in compliance with the specific requirements like a benefits amount, employee contribution amount, the duration. So it's important to understand that each state's requirement, and there's no one fits all private plan that fits all the state's PFML requirements, unfortunately. So even if you like to go through, not through the state's program, but the private plan with that private carrier, you have to purchase that private plan specific to each state. So, and then generally speaking, that each state needs to approve that private plan. And I guess the benefit that some people see is the private plan will coordinate with STD because the private carrier will be administering the claim, but some may see like a premium might be higher or lower. So it's important to do research with the carrier about the private plan, weighing on which fits well with your business objective. And another thing is that so as mentioned, like PFML program generally like share a mini good category, like a similar categories. It covers both employees' own serious condition as well as take time off for the family leave, like bonding. However, details are very different. So it's important to understand each state's PFML. And then we do have a good resource for that we're gonna mention. You can reach out to our consultant as well. And yeah, and then another confusion might be the sick leave that a lot of states or city or even the county level or the Illinois PTO requirements for any reason. So that is very different from the statutory disability insurance or PFML, because PFML is more like insurance that employee contributes to that program, and then it's a wage replacement when that qualifying event happens. Versus the sick leave is more of the PTO accruement that is transacted with the PTO, like a vacation with PTO. So it's very and then also the duration is different as well. And the new trends that we started to see is if you have any employees in New Hampshire or Vermont, you may know this already, but New Hampshire started this rollout of voluntary participation for the private employer. So it's not mandate for the state's employees to kind of stop, like to have that solid pool, and that open up for the private employers and individual, if their employers are not participating, to purchase the PFL in some part of the medical leave employee portion. So some interesting model there. And also additionally, not just the traditional family leave and the employee disability, started to see like kind of organ donating organ, like a time off or safe leave, but bereavement leave. So some, again, like expanding more and more each year. Next slide, please. So just speaking of how different across the statutory PFML program is, I thought, I'm a visual learner, so I thought it's interesting to see like the right side compare each state's weekly benefits that your employee will receive if they are on the PFO or disability leave, if they're qualified for it. As you can see how different they are, right? For example, like New York disability, if you're injured, serious illness, and you have to take disability leave, you get only $170 per week, versus California, you get $16.20. So as you can see, like such a big wide range of weekly benefits, and that's where employer needs to understand the weekly maximum benefits so that you can strategically like coordinate with your own employer benefits as well. Could be a parental leave benefit or could be the STD, how that supplement to make the employee whole if that's your objective. And on the left side, additionally, the weekly benefits are different, very wide range, right? In addition, the maximum duration of how much the employee is entitled to take is very different. States are 8 weeks, some 4 weeks. And then some states require employer contribution depending on the group size, versus some like New York, only like only 100% funded by the employee, versus DC, 100% funded by the employer. And eligibility to take leave is very different from FMLA. Oftentimes they don't have to take certain, like, they don't have to work for certain length. They just need to earn certain amount to be eligible for the benefit. So, an interesting development last year is that definition of eligible family members under family PFL has expanded even more. So, in addition to the core definition under the federal FMLA, they started to add sibling, domestic partner, and not just that, but the employee has a significant relationship they don't have to be blood related, but some connection have the employee have a strong bond connection, family-like relationship, which is kind of hard to like prove, but so it's interesting development, like say New Jersey, Oregon, Colorado, they added that family-like member definition. And additionally, some states add the job protection, like New York PFL has that job protection, but some don't. But even like say California, pay family leave and disability do not have the job protection, but usually those run with the state version of PFML or the federal PFML to provide that job protection and requirement for the employer to continue health plan continuation as well. Next slide, please. So the quick overview of like how that coordinates. So for the common example that we've seen for the qualified event is that pregnancy, female employee pregnancy, take time off, and after a child is born, want to take a bonding leave. So how it usually works is that like if, for example, assumption that if an employer has STD and then that you're in the state that has the disability insurance and a PFL, the statutory requirements, that how it works is the STD, your employer STD runs concurrently with the statutory disability. And while employee is incapacitated with the pregnancy. So, and then after that, like for the bonding with a new child, usually PFL comes into play. And then if you sponsor a parental leave, then that'll run concurrently to supplement the benefits. So as you can see, STD is different from the PFL. They don't run concurrently. And PFML comes into play of cover both qualified reasons. So they do cover kind of like cover both maternity leave time and then the bonding time. And in some states like New Jersey, extend beyond that to cover longer than 12 months. Yeah, so it's and then also important thing is like sometimes some cases like FMLA runs concurrently, and some cases do not. As mentioned, the family definition is a lot more richer for some states. So have to keep in mind that some qualified reason for to care for the family member runs concurrently, but some do not. And next slide, please. So the commuter benefits mandate, sorry, next slide, to kind of speed up. So it's also another trend that we start to see at the states and city level. So here are the list of currently mandating employers, certain employers to offer, quote unquote, offer commuter benefits options like a transit commuting pass or contribution to the van pool. Next slide, please. So among that, I just want to highlight for the Philadelphia and DC. Philadelphia is just took effect December 31st, 2022, so just very new requirement. So it applies to the employer with 50 or more employees who work on average 30 hours per week within that Philadelphia area for that same employer for 12 months. And just need to offer, quote unquote, need to offer to the employees that election of pre-tax payroll deduction for mass transit expense, the list that are there. So requirement is specific. So any combination of those two, and the maximum limit is up to the federal limit. And as you all know, 2023 is $300 per month. Yeah, so for in addition to the Philadelphia, maybe Philadelphia in that center of the downtown, maybe you have an office in the very center that has mass transit that may be more applicable to you. But some employers that we have seen, like Philadelphia and New Jersey are the good examples, like some outskirt of it, not like New Jersey, like except for the northern part, like they do not have much of the mass transit. A lot of it, even though it's a mandate, it's irrelevant, but we hope that, more guidance will be clarified in that case, what will be the compliance. But in the absence of it, like I think the best practice is to just let them know, offer, quote unquote. You don't have to, even if employers don't, it's not the requirement employees have to elect the commuter benefits. Next slide, please. In DC parking cash law, so this applies to employers with 20 or more employees who work at least half of their working time in DC. And this is part of the earlier requirements of the commuter benefits the DC had. And then parking cash law had a requirement to submit the reporting that was due January 15th. And then the objective is to reduce the congestion, and for the Clean Air Act, they are trying to kind of focus on the employers who offer free or subsidized parking benefits must comply with one of the list option there. But even if you do not offer free or subsidized parking benefits, you are still subject to the reporting. The first reporting was due last month, and then next one will be in 2 years later. So it's important to keep in your mind what that is. All right, so hand it back to Kelly.
All right, thanks, Yoko, for covering a couple of very in-depth and complex topics, but definitely important ones for employers that have employees in those states, especially on the paid family leave, where, you know, like you mentioned, and with that map, we're seeing more and more states that are either adding this legislation or, you know, it's working their way through the legislative process. So I imagine we're going to see more and more states added to that list as time goes on. So now we're really just going to kind of close up with some key takeaways and resources. One of the big things I hope everyone's gotten, we've said it many times, it's okay to ask for help. It's a good thing to ask for help because these state laws can be complex. Again, fully insured plans, you're going to want to identify the locations of your workers who are living, you know, outside of your home state or where you have offices. It is very important to communicate with your insurance carrier. Oftentimes those carriers should have insight into some of these state laws that we mentioned today that should apply to those fully insured plans. Self-insured plans, again, you're not completely off the hook. A lot of the times we think of some of these laws not applying to self-insured plans, but as we've briefly talked about today, sometimes they do apply. So self-insured plans, you need to know where your employees are living as well. And then obviously there can be state requirements that affect your employees as well. Obviously, we can't say it enough. Employers should be consulting with employment law counsel to navigate the requirements for a lot of the topics that we've covered today. Then obviously there are things even outside of insurance laws. There are HR rules, you know, hiring practices, wage withholding rules, those type of things that are going to affect it. So make sure that you are working with employment law counsel to make sure you are covering everything. Okay, and then resources. So we do have a lot of resources available, which is wonderful, and I hope will be helpful to you as kind of a follow-up from this if there's a specific topic that we've talked about that you'd like some more in-depth information on. So we did do a webinar last year on paid family and medical leave. So I wasn't kidding when we said we could fill a whole hour with some of these topics. So that is something that you can access through NFP Insight. You can ask your consultant or account team to get you that recording. It's definitely filled with lots of great information. And then we also have a long list of publications on the topics that we've talked about today. So we have things about individual mandate reporting and paid family medical leave. And then we actually have state-specific guides for, looks like 7 or 8 different states, which shows you just how important and how complex some of these rules can be, that we have publications specific to some of those states. So definitely request copies of these from your consultant or account team if you have employees in these various states. And so with that, I think I'll give a quick shout out to Beth to see if there are any questions or anything to answer live or closing remarks from today's presentation.
Sure. So I loved kind of your, I think, slide before last, where you kind of talked about the resources that employers can rely upon, because every now and then we'll get a question from a client that's like, hey, we have employees in these 37 states. Are there any insurance mandates that we need to be aware of? Who is the best source for kind of getting, let's say, a dispositive list of all the things that the plan could be subject to? I'll say it, the insurer. Right? Insurance carriers, because they have to basically comply with state mandates in every single state that they are licensed in, generally are going to be the best, and in my opinion, one-stop shop to know about insurance mandates specifically, as well as whether or not those are extraterritorial, right? Or so whether or not that means that they apply, let's say, to a fully insured plan that is cited somewhere else. They are just going to have that information much quicker than like we will, for example. And then let's see, a lot of people asked the question about the slides, and we will send those out by Friday, as Amber mentioned, and I think she says that in her outro as well. I'll just ask kind of, since we have a couple minutes, do you think we're going to see more and more kind of state requirements coming up? Y'all didn't really talk a lot about the future. I think maybe with regard to one of the subjects, but do you think we're going to keep seeing this?
I wish the answer was no, but I think the answer is yes. I mean, I think on all of these topics, until you see something at the federal level, for some of these leaves, maybe you'll see it, but even then, let's face it, Mini-COBRA is a great example. You have federal rules, but then you still have state rules on top of it. So I definitely think that we are going to see an increase in states kind of getting their hands into a lot of these topics that we talked about today, which again goes back to the point of why it is so important to be working with carriers or employment law counsel to stay on top of these, because it is tough with employees moving all around now that remote workforces really are here to stay.
Yeah, I think that's a really good point. And I mean, frankly, those of you who might be ERISA nerds on the call, you might be saying to yourself, but what about ERISA preemption, right? Which is this idea that ERISA as a law pertaining to benefits is going to preempt state laws. And that's kind of what we believed for like decades. And recently we've had some case law that maybe didn't support preemption, and some that has, right? I think the interesting thing about preemption is that somebody kind of has to sue to get a court to say that ERISA preempts a certain law. And no employer wants to like undertake that responsibility, right? And so it's interesting because as these states get more and more and more active, it really takes somebody to sue them to say that ERISA preempts their law for that to get struck down. So yeah, lots of state activity, if you will. With that, I think we're down like to seconds. And so if no one has anything else, I'll turn it over to Amber to give us her outro.
Great, thank you. Thank you to all of our speakers for sharing your valuable time and expertise with us today. To reiterate, today's presentation was recorded. We will be sharing the recording in the follow-up email and on the NFP website. If there are any portions of this call that you missed, by Monday, you will receive an email with a link to the full recording. The PowerPoint slides used during this presentation will be shared in the same email. At the end of this call, a survey will populate in a new window. Please take a brief moment to complete the survey, as it lets us know what topics are important to our listeners and helps make our education program as current and relevant as possible. That concludes our webinar for today. Thank you, everyone, for joining us, and have a great day.